Oil remains above $110. Long bond yields are back near mid-2000s levels, yet equities have only pulled back modestly. Cross-asset signals are sending very different messages about growth, inflation, and risk-taking. You are watching vTalkInsight, Allocator's Lens Daily for May 20th, 2026. Today we connect the AI-driven equity cycle, the higher-for-longer rates story, resilient credit, shifting currencies, and an energy-led commodity squeeze, so you can frame the balance of risks across your portfolio. In equities, the central tension is between powerful AI-driven earnings and a sharply higher cost of capital. Index-level moves remain contained. The S&P 500 has given back some ground, but volatility is still lower than the macro news flow would suggest. Under the surface, leadership is narrow and concentrated in a small group of AI and semiconductor names, leaving the broader equity complex vulnerable if those winners falter. Demand indicators around AI are extraordinary. Google reports token usage doubling roughly every 2 weeks, with a multi-hundredfold increase over 2 years, and is partnering with Blackstone on up to $25 billion of data center investment. Hyperscale capital expenditure tied to AI is projected in the trillions over the next 5 years, while companies like NVIDIA are expected to post revenue growth of 70 to 80% with margins still expanding. Importantly, earnings strength is not limited to megacap tech. Recent seasons saw double-digit profit growth in most sectors, and AI adoption is helping many firms expand margins, challenging the idea that profitability has already peaked. That backdrop has pulled fund managers into their most overweight equity stance since early 2022, even as high-frequency data show weakness in housing-related spending, softer home improvement demand, and signs that negative real income growth could slow the consumer. The near-term equity story is therefore a tug-of-war. On one side, a potential oil and inflation shock is pushing 10- and 30-year Treasury yields toward levels last seen before the global financial crisis, which is uncomfortable for long-duration growth stocks, particularly semiconductors already showing profit-taking and sharp swings in leverage products. On the other, AI-linked earnings and capital expenditure are still surprising on the upside. How those forces balance, together with upcoming results from key chip makers, will be central for equity volatility and market leadership from here. In rates, markets are extending the higher-for-longer narrative as geopolitical shocks feed into inflation and term premia. The United States 30-year yield has pushed above 5.1%, a new high since 2007, with some strategists warning that a move toward 5.5% could stress other asset classes. 10-year yields in the mid-4% range are already testing equity valuations and tightening financial conditions compared with earlier this year. Behind that move is a messy policy picture. Inflation is running roughly 0.75 percentage point above the Federal Reserve's target, and supply-driven pressures from energy, shipping, and key commodities are expected to push it higher in the near term. Market-implied odds of another Fed hike by year-end have risen materially, yet some forecasters still expect cuts and argue that pricing for further tightening is misplaced. Fed leadership uncertainty and a data-dependent stance are keeping bond market volatility elevated. The pattern is global. Yields across the United States, Japan, and the United Kingdom sit at multi-decade highs as fiscal expansion and reduced central bank buying lift term premia. In Japan, strong nominal growth and expectations of a June rate increase are putting upward pressure on government bond yields. In the UK, gilts have swung on concerns over fiscal discipline and softer labor data. For allocators, higher yields improve income but weaken the traditional diversification role of long-duration sovereign bonds, especially if energy-driven inflation keeps curves under steepening pressure. Many duration-sensitive investors indicate a preference to wait until the current bear steepening phase exhausts itself before adding significant exposure, with round numbers such as 5% on the United States 10-year seen as potential triggers. From here, the path of oil prices, incoming inflation prints, and communication from the Fed and the Bank of Japan will determine whether this adjustment remains gradual or turns into a sharper repricing across global bond markets. Credit markets still look surprisingly calm given the move in government yields. High-yield issuance from technology and AI-related borrowers has accelerated from virtually nothing last year to around $40 billion so far, with many deals oversubscribed 2 to 5 times. The high-performance compute segment of high yield has delivered roughly 10% returns year-to-date, outperforming the broader index by about 800 basis points and attracting continued capital. That strength reflects the perceived economics of AI infrastructure. Data center and chip investments are expected to run into the trillions over the next 5 years, and many issuers are locking in funding using shorter maturities and callable structures that reduce their sensitivity to rising benchmark yields. At the same time, credit spreads in aggregate have remained tight even as sovereign yields climbed, reinforcing the sense that abundant liquidity still supports corporate borrowers and that the impact of higher rates is arriving only gradually. Under the surface, however, fault lines are building. A roughly $100 billion maturity wall in software loans and private credit around 2028 and 2029 is already prompting early refinancings, and higher leverage plus technological disruption may lead lenders to demand stricter terms over time. Banks are also under pressure from commercial real estate exposures and potential fallout from weaker consumer spending if higher energy prices bite. The key question is how long spreads can stay this tight if growth slows while policy rates and long-end yields remain elevated. In foreign exchange, the dollar's reaction to geopolitical and energy shocks has been more muted than in past episodes, but yield differentials still work in its favor. Higher United States rates and resilient growth, helped by AI-related capital spending, provide support, even as some safe haven flows are diverted into gold rather than currencies. Sterling is more clearly on the back foot. Recent UK labor market data showed payroll employment falling by about 100,000, far more than expected, with unemployment edging higher. That combination reinforces concerns about domestic momentum and fiscal risks, weighing on the pound and keeping attention on how quickly the Bank of England can pivot away from its restrictive stance without reigniting inflation. In Japan, strong gross domestic product growth and a wide gap between nominal growth and ultra-low bond yields are increasing pressure on the central bank to raise rates as soon as June. Any move there could reverberate across funding currencies and popular carry trades. For now, though, foreign exchange remains a secondary adjustment channel, with most of the macro shocks still absorbed by rates and commodities. Commodities, and oil in particular, sit at the heart of today's macro story. Brent remains above $110, supported by ongoing tensions between the United States and Iran and disruptions around the Strait of Hormuz. Analysts estimate that every month of delay in normalizing Persian Gulf exports could add roughly $10 to year-end oil prices, pointing to significant upside risk if the standoff persists or escalates. Physical balances are tight. Global oil inventories are being drawn down, and as storage approaches critical lows, price moves can become sharp and nonlinear, especially in Asia and Europe. Refined products are also constrained, with diesel and jet fuel shortages expected to intensify in Europe and United States gasoline markets likely to tighten into the summer driving season. That combination leaves the global economy exposed to an energy-led inflation shock and downside risks to growth. Beyond the near term, there's a strong structural argument for a prolonged commodity supercycle. A decade of underinvestment in energy and mining has left supply constrained just as AI, data centers, and electrification drive power demand higher. Oil and gas producers are generating free cash flow yields in the mid-teens, far above those of capital-intensive technology platforms, and the oil curve is deeply backwardated, suggesting long-dated prices may not yet fully reflect future scarcity. Policymakers are trying to smooth the edges, extending waivers on Russian crude shipments to avoid an immediate price spike, while pushing ahead with renewable energy and grid investment, particularly in Europe. Even so, wealthy investors continue to seek gold as a hedge against both inflation and dollar exposure, and ongoing central bank buying is expected to remain a supportive force. For multi-asset portfolios, the trajectory of oil, refined products, and key industrial commodities is likely to remain the main swing factor for inflation, rates, and ultimately risk assets. Pulling this together, the cross-asset picture shows a tension between an AI-fueled growth and earnings boom on one side, and an energy-driven inflation and higher yield backdrop on the other. Equities still price in robust profit growth, helped by technology and increasingly by other sectors, while rates are adjusting to a world of larger fiscal deficits, supply shocks, and reduced central bank balance sheets. Credit remains buoyant, especially around tech and infrastructure, yet faces a rising maturity wall and the possibility that spreads have not fully internalized slower growth. Currencies reflect local stories in the UK and Japan more than a broad dollar surge, and commodities, led by oil, remain the main transmission channel for geopolitical risk into inflation. Over the coming weeks, the interaction of energy prices, inflation data, and the earnings trajectory for AI-linked companies will be critical signposts for how that balance of risks evolves across assets. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.